For those of you not familiar, Ceres is a Boston-based sustainability nonprofit with over 30 years of experience working on climate change in the United States. We are an advocacy organization and not an activist one. In fact, like all of you on this webinar today, we want to ensure that the US financial system, of which credit unions are a critical and systemically important part, remains safe, sound, and resilient to emerging forms of risk, such as climate risk. I spend a lot of my time during the day working closely with financial regulators and financial institutions. And one question that we hear regularly is, how exactly does climate risk translate into risk for our institutions? Well, it's unfortunately pretty simple. Unlike other traditional risks that banks and credit unions face every day, climate risk is systemic. And as such, it acts to amplify your existing enterprise's risks. It does this through two main transmission mechanisms, which we address in the report. Transition risk, which is the risk that the commercial landscape is altered as a result of climate change in unexpected or disruptive ways. One real life example of this is the risk that residential mortgage insurance prices increase dramatically, or that insurance is no longer available at all as insurance companies withdraw coverage due to climate change. And second, physical risk, which is the risk that was described earlier. Monica mentioned this is the disruption to your borrower's ability to repay a loan arising from physical damage to property, processes, and people. So, for example, catastrophic damage due to intense heat, floods, wildfires, etc., as you heard earlier. Now, getting back to our first of its kind report, I think the key takeaways, Taylor, center around the opportunity for enhanced risk management, so keeping credit unions and their members safe, and around the many opportunities for innovation in creating new climate-friendly products for a credit union's membership. So, digging in just a little bit deeper, on the risk management side, our analysis in our report shows that more than 60% of all US credit unions, which is at least 1.2 trillion in credit union assets, are in fact exposed to the physical risk from climate change. Moreover, federally chartered credit unions, representing more than $141 billion in assets, so 6 to 7% of credit unions, give or take, face a high degree of transition risk based on their field of membership. And finally, our interviews for this report have revealed that the level of climate risk preparedness in the credit union system to date is by and large limited. So, that said, there are several credit unions today that engage in proactive climate risk management, and some of them are on the call today. They're highlighted in our report. And our analysis shows that being climate risk prepared will provide a competitive advantage as green lending programs continue to experience strong demand, especially in the electric vehicle and solar market, and as outlined on a great recent filing blog. Answer. The truth is that the level of climate exposure will vary greatly from institution to institution. And, unpacking a little bit of what I said earlier, credit unions generally will have both physical risk and transition risk. So, one of the drivers of physical risk is going to be the geolocation of your lending portfolio, which is a fancy way of saying, where are your borrowers and where's their collateral? Could the collateral be impaired by floods or wildfires, etc.? And the main drivers of transition risk will be your field of membership. So, what are your borrowers' main sources of income to service their credit union obligations? Does your membership all work for a high greenhouse gas emitting business that could unfortunately be negatively impacted by the transition to a net zero, low carbon economy? Could this in turn impact their ability to repay your loans? So these are the things we think about. In many cases, it's not new technology or fancy computer models that are required to assess climate risk. but rather incorporating climate thinking into the everyday, prudent risk management thinking that credit unions are known for. So take, for example, the mortgage lending. This is the second part of the question you asked, Taylor. The mortgage lending that you do and how much you rely on homeowners insurance to help protect the value of that collateral. Climate change is driving new forms of tenor mismatch and pricing risks into that market that many lenders don't regularly consider in their underwriting process. What do I mean by this? The tenor mismatch risk arises from the fact that the average term of a mortgage asset in the US is roughly 15 years. And that's a lot longer than the insurance contract that is protecting that collateral. So, insurance is roughly 1 year, hopefully rolled over by the insurance company. Before, this may not have warranted special attention, but with climate change driven coverage withdrawal becoming a reality, for example, in California, insurance non-renewal notices are starting to be mailed out. This new risk transmission mechanism must definitely be considered in a credit union's underwriting process. The same dynamics are impacting pricing risk. Again, by this we mean that climate change is causing some insurers to dramatically increase the cost of home insurance, in some cases by a factor of 3. And of course, this additional cost of carry could negatively impact the creditworthiness of your borrower, thus increasing their probability of default. So in summary, when we talk about enhancing or enhanced climate risk management for the credit union industry, we're not talking about boiling the ocean or reinventing the wheel with big government regulations. We're talking about the same tried and true risk management processes credit unions have been doing, but with the additional risk vector of climate risk added into your existing processes. And yes, the research and the interviews we conducted with several credit union leaders led to a handful of recommendations that are in the report specific to the credit union industry. And again, more importantly, they're meant to be practical and actionable. So first and foremost, with the goal of mobilizing employees, customers, and other credit union stakeholders, we respectfully recommend that credit unions publicly acknowledge that climate change poses a risk to their balance sheets and their members. Seems simple, but that activation step is something that hasn't happened enough yet, and that's why it's in there as number 1. Second, credit unions should start to conduct research so they can move up the learning curve quickly on this important and evolving topic. Third, similar to the previous recommendation, we believe you should start collecting climate relevant data for your organization. After all, you can only manage what you measure. And fourth, to kickstart your climate related strategic planning and disclosure efforts, we recommend you leverage what is publicly available online. It's free. There's standards and frameworks. We list a whole bunch of them in the report, but for example, the Task Force on Climate-Related Financial Disclosure, catchy name, their TCFD framework is the gold standard for disclosure and strategic planning, and it's available free online. It's being used across the world by banks, your bank competitors and colleagues as well. Fifth, conduct climate-specific scenario analysis on your loan book. Now, I know, people hear scenario analysis and they think complicated. So what we're talking about is the starting point for this would be qualitative analysis. So what if analysis involving your portfolio and some potential climate scenarios that are relevant to your credit union. The most sophisticated version, yes, the most sophisticated version would be quantitative analysis. But again, this is simply using spreadsheets, some probabilities based on your credit union's historical experience. And there are tools out there to help you do both. Regardless of which one you choose, we have this recommendation in there because, again, scenario analysis is the best way to identify and protect against any black swans lurking in your asset book. And 6, invest in talent across your entire organization. This is something that credit unions have done for a long time, and you should all be very proud of how well you do this. Invest in climate specific talent, onboard as much climate relevant expertise into your credit union so that you have those skills in house. And last but not least, I think this was mentioned earlier, make sure to leverage your state and federal regulators and national association resources. These are your force multipliers in the fight against climate risk. And as our report makes clear, there are a lot of partners like Ceres and Filene out there and ready to help.